How is everyone doing tonight? Welcome to the Strategy Room on this Saturday night. You are here with the banker next door, your host, Dr. Joe Berquist, on this Saturday, October 25th, 2025. Great night for everybody tonight. I've got a lot of amazing news. We're going to look at Evolve Bank and Trust CEO arrested, subprime auto crisis, credit worries amongst regional banks, Fed meeting next week. What's the Fed going to do? We got inflation data, got a whole ton of information for everybody tonight. I just want to thank everybody for hanging in there tonight. Had a little bit of technical difficulties here. I was made aware that last week I didn't realize during the episode I was having some camera problems and had a little bit of glitching, and hopefully not going to have any of that this week. But I did have to go to the kind of cruddier backup camera, if you will. So hopefully this will do okay for tonight and get us through. I did get another camera. Have another webcam, some other things coming here, but unfortunately I couldn't get him here by tonight. So like I said, just trying to make do with what I got at the moment. So hopefully that will be okay. The life of a content creator, right? All right, well, let's kick off tonight with our usual. So we're looking here at the U.S. debt clock. Now, a couple of interesting things on here I would note. Now, first of all, we crossed $38 trillion on the national debt. So we've crossed and a matter of fact, it's crazy because we went from 37 trillion to 38 trillion in basically 90 days, 3 months time. And that's how quickly the national debt is going on now. Basically, you could every 90 to 100 days, we're going to be putting on another $1 trillion onto the national debt. That's how fast this national debt is compounding. So as we can all see, it's a serious problems. Now, I would like to point out one change here that was made to the Doge clock on here. So they now have two different clocks here in the upper left-hand corner. So you can see they have the Doge clock goal, which is 648 billion and change running through there. But then right next to it, instead of the savings per taxpayer, they now have the Doge clock now, which is at 214 billion. So and again, I had asked this question over the course of many months now of, the Doge clock. I'm like, 684 billion. Is that a real number? Because that's not really the number that we have heard put out there. We've heard, as far as a real number, we've heard 100 billion, maybe 150 billion, something like that. The Doge clock now would seem to represent the actual number of $214 billion, which again it's not bad, but that would seem a lot more realistic as to where the number actually is. Now, they were showing, in other words, the 684 billion, what did that equate to in terms of savings per taxpayer? They've now taken that off of the diagram here, and now we're just have the Doge clock now. But I kind of like that now because we have I think a more realistic, a real number. So 214 billion in savings, which is good. I mean, again, I love Doge. I love what Doge is doing. I hope they keep doing it. I would just like to see somebody's in charge over there, but I would just like to see somebody who's more of a front-facing person who could basically come out. I would like to see monthly press conferences for Doge. I'd like to see them come out and basically say, hey, we could do this, we could do that, and just basically keep it rolling. Unfortunately, you have a lot of people in the government that don't want to see that. We'll leave it at that. But just to look at a couple other things real quick. So the debt to GDP is at 120%. Now, that has come down just a little bit. We were at 123% just about a month or so ago. So that has ticked down a little bit, which is good. And that undoubtedly is tying in. So our U.S. federal budget deficit is now down to 1.758 trillion, down from a little over $200 trillion, or I'm sorry, a little over $2 trillion. That's good. I mean, that's again making a little bit of progress, but it's it's kind of like just making a little bit of a dent. Like we need a lot more than that. I mean, we need that federal budget deficit to come down by another $1 trillion. I mean, we really need to start to make progress toward how do we balance the budget? How do we get this back down? Because you can't begin to reverse the national debt if you're still running a $1 to $2 trillion annual deficit. It just doesn't work like that. Now, another thing I wanted to point out to everybody here, because we're going to be talking about this in a minute. So credit card debt. Credit card debt right now is standing at almost $1.3 trillion on total credit card debt right now. And basically, credit card debt per household, a little over $8,000 per household right now, credit card debt. So we're gonna talk about that a little bit more as I get into an article on credit card spending in a little while. But I want to jump in now. Big story of the week, massive story this week, and it's kind of crazy that this was not getting more press. So Evolve Bank and Trust CEO faces, and I'm not even sure if I could say this on YouTube without it getting blocked or something. Basically, I'm gonna call it Child P charges. Now everybody can see it up there on the screen. So the now terminated Bob Hartmeyer became CEO in August with the intent of restoring trust in Evolve, which since last spring has been caught up in a missing funds saga tied to the Synapse collapse. So let me take a second and explain this to everybody. So Synapse is a fintech company that basically worked with both banks and fintech companies. Think of like Chime. There was one called, I think it was like Yoda. I don't think it was pronounced Yoda, but it was like spelled like Yoda. Anyway, Synapse Synapse was called Synapse Financial Technologies. Synapse fails, and now they had like $85 billion missing. No, I don't think it was 85 billion. I think it was 85 million. 85 million in missing funds, but you had, just a lot of customers out, a lot of money. And so they terminated their CEO over it. They brought this new CEO in. He was there to basically, restore trust. And then we get this shocking news this week that this gentleman got arrested. Now, immediately they put out that, he was arrested on non-bank related charges. But the big question was, okay, well, then what did he get arrested for? And now we find out, which is absolutely horrific. But if we go down here, so Evolve Bank and Trust CEO Bob Hartmeyer, 68, was arrested Thursday on 2 Child P related charges, according to Shelby County, Tennessee inmate database. Hartheimer faces 1 count of sexual exploitation of a minor and 1 count of distribution of obscene material. Distribution. Like that's an Evolve spokesperson said Friday that he has now been terminated from his position. We are in close contact with the U.S. Attorney's Office and have been assured that this is a personal matter and does not relate to the bank or its operations in any way, the spokesperson said. That said, we have offered our full cooperation as they investigate. Blake Ballin, Hartheimer's attorney, told Banking Dive via text Thursday evening that he has no comment as the case is under seal. He said he did not know when the case would be unsealed. So a source close to the bank told Banking Dive earlier Thursday that Hartheimer has been taken into Federal Bureau of Investigation custody at his office regarding a personal matter. The CEO's arrest was nothing to do with the bank. No warrants were executed against the bank or bank property, the sources said. So again, just a crazy story. Shocking story here. And unfortunately for the people at Evolve Bank and Trust, just another black eye for them for the moment. And, and my thoughts are with the people of the bank, because I'm sure, like any other company, I'm sure that they have some very good employees and some very good people that work there. And this is just got to be rough. This has got to be rough for them going through this right now. And, and I feel for them right now. But this is just obviously horrible news. And, we'll see. Like I said, I'll keep an eye on this one and we'll see what happens. I'm sure a few months from now, I'll have another update on this one. But let's jump into some of the other ones. Now, obviously, what I'm going to talk about for just a couple minutes, just a couple things on the government shutdown. And then I want to get into the subprime auto crisis, which leads us then into the private credit market, because we've had a whole bunch of updates this week. And I've got a whole flurry of articles. It's kind of interesting that this coincided with basically banks' earning season. So we had a lot of earnings coming out on banks. We got some very interesting information that came out with that. I have a whole slew of articles to go through with everybody, and we're going to begin to paint a picture here of what's going on with a lot of this stuff. But let's jump into the government shutdown just so I can update everybody on this for a moment. So the government shutdown continues as the Senate rejects funding for an 11th time. Democrats cited insurance premium rate increases in their call for Republicans to negotiate on healthcare subsidies in exchange for reopening the government. So the federal government remains shut down as Senate again rejected a stopgap funding measure on October 20th. The 50-43 vote was the 11th time a Republican-backed continuing resolution to extend current funding through November 21st fell short of the 60 votes needed to end the debate in the Senate and bring the matter to an up or down vote. The 20-day shutdown is now the third longest in history, leaving hundreds of thousands of federal workers furloughed without pay and others, including TSA and Border Patrol officers working without pay. Now let's jump to another one. So this government shutdown now becomes the second longest in U.S. history. The government shutdown became the second longest federal funding lapse in U.S. history, the longest one being the first one in the Trump administration, which lasted, I believe, 35 days, which was the President Trump's first term in office. The two longest shutdowns have both occurred with President Donald Trump in office. Democrats want any short-term funding bill to include an extension of enhanced tax credits under the Affordable Care Act that are set to expire at the end of the year. GOP-backed stopgap bill failed to pass in the Senate for a 12th time Wednesday evening in a mostly party line vote. So we've now had 12 votes on this and still nothing there. Now, what does Polymarket say? So how many days will the federal government be shut down in 2025? Basically, we are standing at a 95.3% probability that we will be 30 days plus on this. And this is what I said to everybody when this whole thing started. I said that I felt that this, a lot of JD Vance and some other economists, some other people were coming out on CNBC basically saying that, hey, I think the shutdown's going to last for a couple of days or a week or whatever. I didn't feel that at all. I basically felt like, no, this is going to go for probably over a month. It's probably going to challenge the original record of 35 days. I think we're almost assured at this point that nothing's really going to happen this week. It's going to take us definitely beyond 30 days, probably I would say 50-50. We're going to go over the 35-day mark here at this point. So, but we'll see what happens. But again, I really like this Polymarket. I was watching kind of Polymarket over the election last year, just kind of watching the way that people were basically betting on how things were going. And I find this to be a very interesting tool to use this to kind of see, kind of gauge sentiment. How are people feeling out there right now? Where do they think the winds are blowing, so to speak? So I kind of like Polymarket to look at some of these things here. I think it's really interesting. But again, right now, betting market, if you will, has a 95.3% probability that we're going over 30 days. And again, where we're at with this, and again, not to get overly political, not to get abundantly political with this, but I just think that where we're at is that the Republicans have no reason to cave. I said this from the beginning. They're looking at the polling numbers, and they're seeing polling numbers are fine. They're even inching up a little bit. So if their polling numbers were turning against them, then they'd be like, okay, let's pack it up, let's close it down, and let's work something out and get it done. You're not seeing that. Their base is loving the fact that they're doing this, and it basically, this is in certain respects helping the government in terms of cutting spending and other things. So there's no reason for them necessarily at the moment to stop this. On the Democratic side, they're trying to put up a good front for their base. They're trying to say, hey, we're trying to get this, that, and the other thing. But at the same time, a lot of their demands are utterly ridiculous. And I think that's another reason why the polling is held up, because I think if they had legitimate demands for legitimate things, I think the polling would be different. But but you're not really seeing that. So again, and this leads me into right now to this. So and this is kind of the final piece I have on this here tonight. But when government could reopen, key dates to watch for. So let's go down and look at a couple of the key dates here. So 17th, we're already, all right. So the 24th, which was yesterday. So on October 24th, more than 2 million federal workers will miss their first full paycheck. While a 2009 law technically guarantees back pay, missing income will add financial strain on families, particularly in regions with large federal workforces. Air traffic controllers, more than 10,000 of whom are currently working without pay, remain one of the most closely watched groups. During the 2019 shutdown, a wave of unscheduled absences among controllers forced cascading flight delays and helped bring that standoff to an end. Now, imagine, if you will, cascading flight delays on Thanksgiving. Just a few. I mean, obviously, the Wednesday before Thanksgiving, largest travel day of the year. Yeah, people, as you can imagine, people aren't going to be, too happy with that. So my guess is, my guess would be something probably happens before Thanksgiving, but we'll see. A second flashpoint is October 31st, when more than 1 million active duty service members face uncertainty over their next paycheck. The administration used roughly $8 billion in leftover Pentagon research funds to cover military pay on October 15th, but some lawmakers say that funding maneuver cannot be repeated. Now, I will point out we did have an interesting development here because somebody came forward and basically gave the government $130 billion to basically pay the servicemen and keep them going. So I think that issue for October 31st has basically been kind of resolved, at least for the moment. So again, another reason, giving Republicans, why cave? Why cave? If they have the money to cover the service people, and they can figure something out with the air traffic controllers, yeah, not really, again, not really an interest, and not really nothing, again, no incentive really for them to cave at the moment. So again, but I just wanted to point out a couple of interesting dates here to look at. Poly market, they think that basically we're going 30 plus days, and and we'll see what happens with this. So all right, let's go on here. I want to talk about the subprime auto loan crisis, basically, that we're in at this point. So I would point out to everybody right here, big news of the week: subprime lender PrimaLend Capital Partners files for bankruptcy protection. This was huge. This was coming right on the heels. We had Tricolor Holdings fail a couple of weeks ago. That was followed by First Brands, which failed. And now we have subprime lender PrimaLend Capital Partners basically throw it in the towel, third big bankruptcies. Now, there have been others, and I'm going to share those with you in a minute as we go through a few of these articles here. But let's just look at this first. So subprime lender PrimaLend Capital Partners filed for bankruptcy protection on Wednesday in another sign that low-income consumers in the United States are under strain. The company's filing in a Texas court showed that it listed both assets and liabilities of less than $500 million. PrimaLend provides financing to consumer and specialty lenders through asset-based credit facilities. It also serves the buy here, pay here auto financing market, where dealers sell and directly finance vehicles for customers with poor or limited credit. We want to be clear, there is no impact to our dealer borrowers' loans or terms. No debt is being called due or accelerated as a result of this process, PrimaLend CEO Mark Jensen said. We are pursuing a sale process to maximize value of the business and strengthen our balance sheet. The company is operating as usual with no disruptions, it said the statement, reiterating that it is not going out of business, even though it filed for bankruptcy. Bloomberg News first reported on the bankruptcy earlier in the day. Subprime lenders provide loans to borrowers with weaker credit histories or lower credit scores. Last month, Bloomberg News reported that PrimaLend's creditors were weighing pushing the firm into bankruptcy after going unpaid for months. Yeah, that sounds like a problem, right? Many lower income consumers, according to analysts, are finding it harder to keep up with payments, prompting an uptick in delinquencies across auto, personal loan, and credit card portfolios. The strain reflects the cumulative impact of high borrowing costs, rising living expenses, and depleted savings, which have left subprime borrowers particularly vulnerable to financial shocks. I would also point out that there's this little thing called the border being closed, and that there's this little thing called illegal, undocumented people getting sent back whence they came. That, I think, is having a crimp on business as well. I think they of course, Reuters would leave that out, naturally. But let's take a look at some of these other things here, because I think you guys are going to find this interesting as we roll through this. So Auto parts companies' bankruptcies rattle credit markets. What to know? Failures among auto parts firms and subprime lenders may signal broader risks, but a strong economy and falling rates limit spillover, analysts say. Yeah, I don't know about that. I don't know about that. So let's see here. So as I said, we had Tricolor Holdings, we had First Brands, and now we've had this Primalend. Now, those are the three big ones. Let's take a look at some of these smaller ones that have also happened that have flown under the radar. So the U.S. economy has remained resilient in recent months, but auto parts companies have not. The increasing number of bankruptcies in the auto parts industry is unsettling the high-yield credit markets, i.e. the private credit market. This upheaval is making it increasingly difficult for low-income consumers to purchase cars and is also compelling banks and financial institutions to write off loans to these failed companies. On June 11th, auto parts supplier Morelli Holdings filed for Chapter 11 cases in the United States Bankruptcy Court for the District of Delaware to restructure its long-term debt obligations. On August 18th, Car Toys, which describes itself as the largest independent multi-channel specialty car audio and mobile electronics retailer in America with multiple locations across the western U.S., filed for bankruptcy. On September 10th, Tricolor and nearly a dozen of its affiliates each filed a petition in the United States Bankruptcy Court on the Northern District of Texas to transition from Chapter 11 of the United States Code to Chapter 7. This transition allows Tricolor to move from reorganization to liquidation, which involves the ending of the business and the selling of the assets, of which there are not many. And then it goes into, explains there, and then it goes into on September 28th, First Brands Group, LLC, and 98 affiliates. So we had how many affiliates with So Tricolor had a dozen affiliates, and First Brands had 98 affiliates filed for Chapter 11 bankruptcy. The failure of these auto parts companies has sent shockwaves through the higher yield or junk credit markets, with the ICE B of A high yield index rising by nearly 50 basis points since mid-September. Yes, this is causing a problem. And then it gets into, Jefferies Financial, which we'll talk about in a second. JP Morgan disclosed $170 million charge off. Jefferies Financial expects to incur a $43 million loss resulting from First Brands. The situation worsened toward the end of the week as a couple more regional banks, Western Alliance Bancorp and Zions Bancorp, announced write-offs, prompting a sell-off on Wall Street. Auto-related bankruptcies of companies like First Brands and Tricolor signal stress in pockets of corporate lending to consumer-facing companies, but they also reflect consumer demand headwinds likely to impact other industries. And again, I wanted to read this to give everybody a flavor for there are a number of companies that have failed here in the last, just in the last, 2 months. This has not been we're going to see some other articles here in a little bit as we go through the night here. We're going to see some articles here that are basically going to try to describe this as a one-off, this is a bad debt, but it's just a one-off. It's a one, no, this is not a one-off. This is not a one-off. I'm presenting you the evidence here that this is not a one-off, that there are multiple. We're now up to 5-6 different companies that have now gone under. Let's see here. Now let's get into Jefferies here. Now Jefferies, very interesting company that was tied in with certainly with First Brands. And how did they get into the middle of this? And now they're crying foul, basically saying that they were defrauded. So Jefferies shares pair losses after CEO says First Brands defrauded the bank. Rich Handler doesn't see the collapse of the auto parts supplier as a sign of broader credit issues. They never do. It's funny, if you study markets and financial crisis long enough, you see there's a pattern. The first thing is when a big company goes down, the first thing they say is like, oh no, there's not a bigger problem, nothing to see here, everything's good. It's always the first thing. So Jefferies Financial Group appears to have calmed investors' worst fears about the bank's involvement in the collapse of auto parts maker First Brands Group. We believe we were defrauded. Jefferies' chief executive officer, Rich Handler, said at the bank's previously scheduled investor day on Thursday. Jefferies shares rose nearly 3% Friday after having tumbled 11% Thursday, following a report in the Wall Street Journal that detailed the firm's ties to First Brands. We're going to get to that in just a second. Concerns about wider credit issues also had sent the banking sector tumbling Thursday. Jefferies shares are still down around 20% over the past month. Jefferies had been hired over the summer to help First Brands refinance corporate loans, while its asset management division had extended $715 million of financing ties to the company's accounts receivable. The financing never happened, and the asset management division stopped receiving payments from First Brands in mid-September. Roughly $45 million of the financing was held by a Jefferies fund, while its investors held the rest. So First Brands filed for bankruptcy. It's very clear, and we're as frustrated as anybody else. We don't know exactly what happened with First Brands, and the details will come out as the bankruptcy process unfolds. First Brands declined to comment. Fears about systemic credit problems Thursday were primed when a fresh instance of alleged credit fraud was disclosed at two smaller banks, but banking stocks edged up Friday. Fifth Third Bancorp, which initially raised concerns about fraud at subprime auto lender Tricolor, sparked those broader issues. Said Friday it had given its portfolio a comprehensive review and wasn't concerned about a broader credit collapse. Now, if everybody remembers, with Fifth Third Bancorp, I just did an episode a week ago. They just did one of the biggest M&A transactions in years by agreeing to purchase Co-America for $10.9 billion. So, and then of course, right after that merger, they were forced to release information here on Tricolor Holdings and basically say that, like, yeah, we're going to take a hit from Tricolor. And on we go here. So, but let's look at, so how did Jefferies end up at the center of this? This is the big question. So the investment bank's deep ties to the auto parts maker draws questions. So the sudden collapse of auto parts giant First Brands Group has left Wall Street firms sorting through the wreckage. Few are facing more questions than Jefferies Financial Group, a supporting player in the finance world that now finds itself in the harsh spotlight of an accounting scandal. The firm played important roles with First Brands through both its investment banking and asset management division. First Brands sells billions of dollars worth of parts, including oil filters and windshield wipers, annually to customers such as Walmart. The Cleveland-based company filed for bankruptcy. First Brands unraveling has raised questions about who could have seen it coming. Jefferies had worked with First Brands for several years without issues when its bankers set out to help the company refinance corporate loans over the summer. Jefferies initially told prospective lenders that First Brands had roughly $5.9 billion of debt, according to materials viewed by the Wall Street Journal. First Brands bankruptcy advisors have since said its debt actually exceeds $11.6 billion. In the marketing materials, Jefferies highlighted a financing arrangement for First Brands in which the company sold accounts receivable to financial institutions, but it didn't spell out that in some of these deals. Money flowed through First Brands before it was repaid to the institutions. Jefferies told lenders that these financing arrangements weren't debt-like. Jefferies shares, which hit a record high late last year as the bank executed an aggressive plan to lure top bankers and work on bigger deals, are now down nearly 30% since last month. Although they did, you can see in the chart here, their shares did rebound a little bit here. So Jefferies had worked for First Brands and a predecessor since 2014. Its investment banking and capital markets divisions, which accounts for the bulk of the firm's revenue, have advised the auto parts supplier on one acquisition and various financing efforts. So in other words, Jefferies had been tied to First Brands for quite a while. This wasn't a new relationship. This was a relationship that had gone back at least 10 years and had multiple facets to it. There was kind of like the financing arm and the hedge fund arm, or investment banking arm, if you will. And basically what Jefferies was doing, at least on the finance side, was basically providing what's called factoring financing. Basically, you're basically lending against accounts receivable. The problem is that First Brands, at least apparently, looks like they pledged the same collateral to get multiple loans with multiple different organizations. That's why the people at Jefferies are saying, oh, we got defrauded, because we didn't know that they were out there, pledging the same collateral for a number of loans through a bunch of different. Remember, we said a few minutes ago they had 98 affiliates. It was they acquired financing through all these other affiliates using the same collateral from the main First Brands entity to support all this, and that's why it's a big fraud. It's a giant mess. But it also just goes to show you that, what is out there. Like, in other words, Jamie Dimon described this week as cockroaches. He basically said, yeah, where you see one cockroach, there's usually more. And I agree with that sentiment completely, because that's basically exactly what we're seeing right now. We're seeing an unfolding of more of this. Now, let's take a look at a couple other things here real quick. So the alleged sweeping betrayal of trust that rocked Zion's Bank and spooked Wall Street. So Zion's Bank Corporation lost $1 billion of its valuation in a single day on Thursday after disclosing $60 million worth of loans it had made that were unlikely to be repaid. What led to that point was a messy, tangled web of loans that Zion said were surreptitiously subordinated by the borrowers, all while the collateral was effectively eliminated. Shares of regional banks tumbled on Thursday as fears mounted around the health of their lending businesses. Zion's 13% share plunge ended up sparking worries about possible broader issues with lending for the regional bank sector, knocking the whole U.S. stock market on Thursday, with the Dow Jones Industrial Average finishing lower by 300 points. Zion's subsidiary, California Bank and Trust, is suing Andrew Stupin and General Marcel, the until now relatively unknown managers of several funds utilizing the name Cantor Group, along with their associate Deba Sham. The lawsuit filed in Los Angeles County on Wednesday alleges a sweeping betrayal of trust by sophisticated financial borrowers who abused CB&T's confidence, manipulated loan structures for their own enrichment, and systematically eliminated the collateral protections that were supposed to secure the bank's loans. Zion's and a lawyer representing the defendants didn't respond to CNBC's multiple requests seeking comment. The relationship in question stemmed from about $60 million in financing that Zion CB&T made in 2016 and 2017 to two related investment vehicles, Cantor Group 2 and Cantor Group 4, which tied back to Jefferies. The credit facilities were to be used to fund the purchase of distressed residential and commercial mortgage loans. Zion said they had an underwritten agreement guaranteeing them first priority interest, meaning the bank's claim on collateral was superior to other credits claims in the event of default. However, the deeds that were supposed to secure the loans were ultimately subordinated without CB&T's knowledge. Zion says in the lawsuit, those underlying properties were transferred to other entities or were in foreclosure, meaning the collateral was irretrievably lost. So this is, again, so what you're seeing here is a ballooning issue with multiple issues running through, kind of exactly what they said, a web of loans, web of collateral, tying in a whole bunch of different lenders, pulling a lot of people into this. This is what you call contagion. All right, now let's examine these related things for a second. So Americans are falling behind on their car payments. So delinquency rates on subprime auto loans are at records. And wait till you see this chart. One of the cylinders in the U.S. economic engine is causing some sputtering. Since the pandemic, buyers on auto dealer lots have encountered surging sticker prices and smaller incentives from automakers to lessen the blow. To afford an automobile, more consumers, especially lower-income families, have resorted to buying used cars and taking out longer loans. Now, more are falling behind on their loans, signaling that lower-income consumers are struggling to afford payments as wages stagnate and unemployment ticks higher. While the economy has remained strong, the Wall Street Journal has kept buying subprime auto. The Wall Street has kept, but not the Journal, has kept buying subprime auto loans. The auto market is evidence that not all is well under the hood. The percentage of new car buyers with credit scores below 650 was nearly 14% in September, roughly 1 in 7 people, J.D. Power said last month. That is the highest for the comparable period since 2016. And the portion of subprime auto loans that are 60 days or more overdue on their payments hit a record of more than 6% this year, according to Fitch Ratings, while delinquency rates for other borrowers have remained relatively steady. And I mean, just look at this. I mean, look, the prime borrowers have remained pretty steady here at the bottom. Subprime, I mean, you could just see, this is spiked up. When was this? So since May of 2021, over basically the last 4 years, for basically about 4.5 years. I mean, this is just as what you call skyrocketing delinquency here, which is pretty crazy. And you could begin to see here how this is time. This is what I'm trying to do here. I'm trying to show everybody a flow of articles that is going to begin to paint a picture here as to what is going on here. So it's not just so these companies are failing, but it's a lot of these companies that are tied into the subprime auto market. And now you could begin to see from this chart here that the subprime auto delinquency is beginning to skyrocket. Now, 6% in the grand scheme of things, that may not sound like a lot, but it's a lot. It is a lot, but I'm telling you. So if I could put this in like a banking terminology for everybody for a second. So if you look at it, if you look at a bank, when you're looking at a bank's delinquency and you're trying to gauge, like, okay, is their delinquency good or bad? So think about it like this: if a bank has 1% delinquency, that's kind of average. It's about so basically a 0.5% to 1% is kind of average for just about every bank out there. It basically signals that they have very, if a bank's got, like 0.75% delinquency, they got pretty strong credit quality. Credit quality is usually pretty good. Not too much is going on there. They might have one or two bad, maybe they have one large bad loan that maybe caused some problems or something, but nothing to be panicked about. Not the end of the world. Okay, if a bank is below a 0.5% in delinquent loans, they're doing really good. That means their portfolio is really pristine. If a bank is over 1% in delinquency, that's when you should start asking questions. If a bank is like 1% to 1.5% delinquency, you should be going, okay, that should be setting off some red flags. And you should be going, okay, what's going on there? Why is that bank's delinquency elevated? You would consider that a 1 to 1.5%, you would consider that elevated delinquency. If you see a bank that's got just 2%, if they have just 2% delinquency, there is a big problem going on there at that bank, and you need to start looking in there and going, okay, you need to start looking under the hood and going, okay, what is going on here? Because something big is going on here. And I want people to realize that it does not take a huge amount of delinquency to sink a bank. Like, in other words, if I asked people on the street and I said, if I just went up to somebody and said, listen, how much delinquency do you think it takes to sink a bank? Like how much of their loan portfolio needs to go bad? Is it 5%, 10%, 20%, 30%? I think a lot of people would probably go, oh yeah, probably 20, 30% of their portfolio probably has to go bad before they go under. No, 5%. Yes, 5%. If 5% of a bank's loans go bad, they could probably go under. Now, the one thing that's in banks' favor right now is that capital ratios are much higher than they were. If you go back to the 05, 06, 07 time period leading up to the Great Recession, and the big financial market collapse and everything in 07 and 08. If you go back, a lot of the bank capital ratios back then were only 4, 5, 6%. And so if a bank had 5% delinquency and you only had 5% capital, guess what? Game over. Game over. Now, a lot of banks out there have, 9, 10% plus, capital ratios. So they certainly have a lot more capital with which to combat, delinquent loan issues. That being said, you start getting 4, 5, 6% delinquency. That's a major problem. And that is still a problem that could potentially sink a bank. So again, it does not, the reason why I point that out is it does not take that much to sink a bank. And that's why, when you see subprime debt at 6.43%, that is huge. That is a huge number. And that's why, to me, this is a big deal. This is a big deal to look at this. So, all right, let's go on here. Demand surges for private credit secondaries amid market volatility. Now, this article was from October 8th. This is going back about 17 days now. But I just want to show this to you. This came out just before a lot of these stories started to pop. So general partner-led deals are helping to boost credit secondary growth as the private credit market continues to mature. So the secondary market for private credit assets may be much smaller and younger than its private equity counterpart. Not much, but it is rapidly gaining ground. We're seeing a substantial increase, said Jeffrey Griffins, the global head of private credit at private capital advisory firm Campbell Lytjens. These transactions have picked up the pace this year. Secondary deals for private credit assets exceeded $12 billion in 2024, up from around $9.8 billion in 23 and just $7 billion in 2022, according to a recent Campbell Lyons report. Each projects deal volume will top $14 billion this year. Secondary investors and intermediaries expect the uptick in private credit secondary deal making to continue into at least the first quarter of 2026, with some managers even expecting the spike to become a permanent feature of the private credit landscape. Yeah, well, we shall see when, as all these deals continue to go bad. We'll see here. Now, and again, this is only talking about a specific feature of the private credit market, not the entire private credit market itself. The entire private credit market is now up to about $1.7 trillion. $1.7 trillion. This is just the private credit secondary deal volume surges. So this is just in one aspect of the private credit market. But I wanted to, just show this to people, just to give everybody an idea, that this, the private credit market continues to churn. It continues to churn, continues to grow every day, without a lot of, nobody's hitting the brakes right now is basically what I'm saying. You're still seeing, you're seeing deals, you're seeing deals go, but nobody's hitting the brakes. These things are still flowing. They're flowing right along. All right, so we'll come back to, like I said, I have a whole bunch of other articles and stuff to show everybody related to this as we get it more into bank earnings and some of the other stuff. But I want to switch gears because I did want to talk about interest rates a little bit. I got some tariff-related news I wanted to tell everybody. There was some big news there. Just show everybody a couple other stories and things that are out there. And then, like I said, we'll come back to, we're going to come back to the whole, credit issue for banks here a little bit later. So, but let's take a look at this. So here we have the 10-year Treasury note. I just wanted to show this because just as I had been predicting over the last few weeks, we saw the 10-year Treasury actually go below 4%. And which, so basically here, I think this was just yesterday, we got down as low as I think it got as low as 3.7. I could get this right. Well, 3.968 here. It did, like I said, it flirted going just below 4%, and then it kind of bounced around a little bit and ended back up just a hair over 4%. But we're kind of hovering, at least for the moment, right around where I were hoping we were going to land. Now, the big question is, are we going to find kind of resistance and support levels here at this 4% mark? I think that could be a very big possibility. I think that there is a possibility that we could just kind of in a certain respect, just get stuck here at 4%. And I'm going to show you guys another article here, a Wall Street Journal column piece that I had out that I have over here. I'm going to load that up in a minute, just to show that to everybody, because I think people will find that interesting. So, but again, rates kind of right where I was hoping that they would get to be, and they had this ultimate effect. So mortgage rates fall to the lowest level in over a year. A home buyer with a $3,000 monthly budget can now afford a $473,750 home, up from $447,000 a year ago. So mortgage rates fell to their lowest level in more than a year this week, improving affordability and bolstering home buying purchasing power. But the drop has yet to spark a significant revival in housing demand as buyers remain cautious. Freddie Mac said October 23rd that the average rate on a 30-year fixed-rate mortgage declined to 6.19%, down from 6.27% last week, and nearly a full percentage point below its January peak above 7%. The rate is now the lowest since October of 2024, when it briefly hit 6.12%. Mortgage rates continue to trend down this week, hitting their lowest level in over a year. And I think it says as of the start of 2025, the 30-year fixed rate mortgage surpassed 7%, while today it hovers nearly a full percentage point lower. This dynamic has kept refinancings high, accounting for more than half of all mortgage activity for the sixth consecutive week. Rates on the 15-year fixed mortgages, often used by homeowners to refinance, also eased to 5.44% from 5.52% a week ago, Freddie Mac said. And then below that, it says, affordability improves, but buyers are still wary. So, again, what I said there, if we can get rates down into the fives, that's kind of the victory that we're looking for there. If we can get, I have ultimately said we need to get interest rates cruising back down closer to 5%. Like if we can get them between like 5 and 5.25, that's the ultimate goal. That's what we're looking for. That's will really help the mortgage market really begin to pick up steam. But I will warn people that, again, the 30-year fixed rate here is, it is dominated by the 10-year treasury. The 10-year treasury yield, this is what so many things in our lives are tied to this 10-year treasury yield. Credit card rates, auto loan rates, mortgage rates, it's all tied to this. So while the Fed, when the Fed decreases rates, they're decreasing what's called federal funds rate. And the federal funds rate does influence a lot of rates, but it doesn't necessarily have a direct impact on the 10-year treasury yield. It has kind of an indirect impact. So again, you might see a phenomenon here of the Fed cutting the rates here as we go through the end of the year, but this 10-year treasury not really moving very much. It might stay here. In order to get rates, like I said, if we were going to get rates back down to say 5%, we would probably need the 10-year treasury to drop down to probably 3%, maybe a little bit below 3%. But a lot of that has to depend on the debt markets and the amount of, how are the treasury auctions going? Are they selling the debt? What do investors see as do they feel like they're getting paid? It's a risk return, risk reward. Are investors that are buying these 10-year treasuries, do they feel like they're getting paid enough for the risk that they are taking? That's the big question. And that's what will, if they feel like they are, and they feel like everything is good in the bond market, the treasury market, the stock market, then this rate will continue to come down. If we see hiccups, or if we have a hard time, if the government has a hard time with these treasury auctions selling the debt, we could see this rate spike back up. But again, this is the key rate. This is what we're looking to drop here. If this drops, mortgage rates are going to continue to come back down. But like I said, I thought it would come back down to 4%. I thought it would dip just a little bit below 4%, which it did briefly over the last day or two. But we have to continue to keep an eye on it to see what's going to happen with it. I'm like I said, right now, what I'm concerned in the short term here is that we are going to find some kind of support or resistance level here around 4%, and it might sit here for a little bit. It might sit here for a little bit until we see maybe how some things in the market play out with with some other things here. So. But like I said, but for right now, for right this moment, everything is, at least at the bonds, everything's kind of, right where we want it to be, at least for the moment. So, all right. Yeah, we went through that. And then, lower mortgage rates push home sales up in September, but prices are still stubbornly high. Yep, absolutely. All right, now let's talk about inflation here for a couple minutes. So the inflation rate hit 3% in September, lower than expected. And this was from the long-awaited CPI report that we got yesterday. A lot of the government data, the economic indicators that I always look at and I always talk about, a lot of stuff because of the shutdown has not been coming out. And we may not get another inflation reading in October. We're going to talk about that in just a second when I get to that article. But let's take a look here. So the CPI, Consumer Price Index, showed a 0.3% increase on the month, putting the annual inflation rate at 3%, both lower than expected. Excluding food and energy, core CPI showed a 0.2% monthly gain and an annual rate also at 3% less than forecast. The Bureau of Labor Statistics released the data specifically because the Social Security Administration uses it as a benchmark for cost of living adjustments and benefit checks. We'll talk about that in just a second. Otherwise, the federal government has suspended all data compilation during the shutdown. So prices that people pay for a variety of goods and services rose less than expected in September, according to the Bureau of Labor Statistics report Friday, that keeps the door wide open for another interest rate cut next week. We'll talk about that in a second. The Consumer Price Index showed a 0.3% increase on the month, putting the annual inflation rate at 3%. Economists surveyed by Dow Jones had been looking for readings of 0.4% and 3.1%, respectively. The annual rate reflects a 0.1 percentage point uptick from August. Excluding food and energy, the core CPI showed a 0.2% monthly gain and an annual rate at 3%. Compared with estimates of 0.3 and 3.1 respectively, core CPI on a monthly basis had posted a 0.3% gain in both July and August. The CPI reading is the only official economic data allowed to be released during the government shutdown. So basically, if you can see from the chart here, we are right on pace where everybody thought we would be at this point in time. So it can actually a little less. So again, good inflation number here, at least for the moment. The question that we all have to ask, and this is what I have been asking with inflation. I have basically felt that it's not so much that inflation was going to go up, it's that inflation was going to just settle in, and we were going to end up with somewhere in a range. Now, again, I have reported over the last couple of weeks that the Fed, that this was exactly their projection, that basically that inflation was going to crest at 3% here in the fourth quarter of the year, and that basically starting in 2026, the inflation was going to start ratcheting it down, and it was going to come down throughout 26 to 27, and was probably going to settle in somewhere around like 2.3, 2.4% over the next couple of years. And so and again, and it's kind of funny because I pointed this out a couple of weeks ago that, the Fed, Jeremy Powell, with all of the hand wringing and the procrastination, and the concern, the inflation. And yet when you looked at their projection, it's like, okay, you project it's going to be 3%. And then it's going to start going down, come January next year, which is a couple months away. Like what? Like so where's this massive concern that we're going to get this, huge amount of inflation? So again, I have not been one thinking that we're going to get this massive wave of inflation, but rather we're going to get we're in a little bit of a, I guess you could say, a new normal in terms of like, the Fed has their 2% inflation target, and we're not going to hit 2%. We're probably not going to hit 2% anytime soon. I think we're going to end up in this bandwidth of somewhere between like this 2.4 and 3% range on inflation, and we're probably going to stay there for a while. Now, what is keeping that inflation up? If we go back to our debt clock here for a minute, it's this. It's the 38,000 in national debt. It's the 1.7 trillion annual budget deficit. This is what is keeping this inflation up. I guarantee you, if you cut this number, if you cut this 1.7 trillion dollars in our federal budget deficit, if you got us back to a balanced budget, I promise you that where are we at here? I promise you that this 3% inflation number would come back down. I guarantee this would come back down to 2% tomorrow. If we cut, again, it's all about the spending. The spending is the government spending is what drives the inflation, the creation of more money getting pumped into the economy every year. This is what keeps the inflation up. Now you've seen that the spending has slowed. Remember, we had this massive amount of spending that got dumped in, and then inflation shot up from the government. Now the spending has been pulled back, and as the spending has been pulled back, we've seen inflation come down from 9% all the way down to 3%. But the inflation is still elevated at 3% because we're still spending way more money than we should be. So if that spending comes down, you'll see this inflation begin to come down. It is absolutely correlated. But again, to drive home the point here, this inflation number was good, and it should pave the way for another rate cut from the Federal Reserve here at next week's meeting, which we'll get into in just a second. But before that, What's the inflation rate in October? We may never know. So the White House said October's inflation report is unlikely to be released. The ongoing government shutdown has closed the government's statistical agencies, leaving critical economic data unreported. So the Bureau of Labor Statistics is likely to skip a month of data collection for the CPI for the first time in its history because of ongoing government shutdown. The CPI, a widely watched gauge of inflation, is unlikely to be released for October. The White House said on Friday the CPI is based on prices collected by an army of surveyors who are currently on furlough and not working because of the government shutdown. Because surveyors cannot deploy to the field, the White House has learned there will likely not be an inflation release next month for the first time in history, depriving policymakers and markets of critical data and risking economic calamity. We'll see. I don't know about all that, but we'll see. But again, we might. Yeah, I mean, we've already been flying here for a little bit now, for a few weeks with basically no economic indicators, and we're going to continue to roll on with that for at least a little bit longer. We do have some other alternatives that we can look at. And I will probably be presenting some of those to you guys in the next couple of weeks if everything stays the same. If the government shutdown continues unabated and continues to roll forward, I will, again, I'll provide you guys with some alternative, data out there that we can look at and try to get a better idea as to, what's going on. All right, let's roll on. Okay. As I promised, I wanted to talk about this credit card trends. Tell us about the U.S. consumer in charts. So there is a trade war, a government shutdown, and a sluggish job market, but households are still spending. Isn't that wonderful? So average quarterly spending per card by credit score. So what does this chart tell us here? Well, this chart tells us that every category is up a little bit, but those with the highest credit scores, those with 720 and up, are spending a lot more money. Their average quarterly spending per card is about $2,300. And people with the 660 to 719 range, their spending is up, and it's a little over $1,000, maybe about $1,100. And people under a 660, their spending is also up, but it's up to maybe just a little bit over $500. But the spending of people with an under 660 credit score has remained a little bit more muted. Like I said, whereas people with the 720 and higher, probably people in higher income brackets, they continue to spend unabated. So Americans may feel worse about the economy, but they are still wielding their credit cards with confidence. So an escalating trade war, a prolonged government shutdown, and a stagnant job market have economists and analysts fearing that consumer spending, a central driver of the U.S. economy, might slow down. The concerns have focused on lower income households, where there have been some recent signs of stress. But recent earnings reports from major credit card issuers such as JPMorgan Chase, Bank of America, and Capital One show that spending growth remains robust. Delinquencies are easing, and some banks are starting to lend more freely. Cardholders are carrying higher balances, but banks still express confidence about the overall health of consumers for now. The U.S. consumer and the overall macro economy have been quite resilient so far in 2025. Capital One Chief Executive Richard Fairbank told analysts on an earnings call this week. But I do think we're in a period of elevated economic uncertainty. So spending on 6 credit cards across 6 of the country's largest issuers rose 7.5% in the third quarter compared with a year ago, continuing to outpace inflation. So again, top 6 cards here: Amex, Chase, Bank of America, Citi, Wells Fargo, and Synchrony. You can see the spending growth is all up for each one of them. At the top, Chase and Citibank, and who else? And Amex, basically around 10%. So both, some of these guys are doing pretty good. So average monthly spend with the primary credit card by annual fee. So annual fee of less than $500, seeing a little over $1,000. Annual fee of $500 or more. So in other words, people that get a lot of rewards points and things like that, they're up over almost $2,600. change in number of credit card accounts openings from a year ago. So you can see here, like, pretty good. Like Citigroup, Wells Fargo is doing pretty good, but Bank of America and American Express are down a little bit. So again, just some interesting numbers there to think about. Delinquency rates on credit card loans are down from their recent peak. So basically in April of 2024, we started to see, you could see here going from, again, July of 2021. And you see that if you guys remember the subprime auto chart that we looked at just a little while ago, you could see it kind of mirrors this, right? You saw in, July of 2021, delinquency very low. And then over the next 4 years, we see this spike up. April of 2024, we hit a high of 3.23%, but then we have creeped down since, still relatively high at 3.05%, but it has come back down a little bit. But again, if we go back to this subprime auto chart here, again, you can see down here, look at this, June of 2021, May of 2021, we were down here at 2.58%, and then up we go here, 6.8%. So you can see here that these charts are basically mirroring each other in a very real way. That's one of the reasons I wanted to show this, and I wanted to point it out so you could kind of get an idea of the credit card delinquency that's out there right now. So it's very interesting. So delinquency has edged down a little bit. Consumers are still spending. People, obviously, higher income earners with better credit scores, still spending away. Still not having much issue with the spend. Okay, Social Security Administration announced their 2026 COLA benefit, an increase of 2.8%. And what does it mean for you? That's it. Any retirees, anybody over 65 out there? I'll point out, actually 62. You can declare for retirement starting at 62 years of age. I shouldn't say that. I shouldn't say just 65. So if you're 62 years or older, you will obviously pay close attention to this right now. So the Social Security cost of living adjustment will be 2.8% in 2026. The Social Security Administration said Social Security retirement benefits will increase by about $56 per month on average starting in January. Over the last 20 years, the Social Security COLA has averaged 2.6%, according to the Senior Citizens League, a nonpartisan senior group. The Social Security cost of living adjustment will be 2.8% in 2026. And let's see here. The cost of living adjustment, or COLA, provides an annual adjustment to both Social Security and supplemental security income to help ensure those benefits keep up with inflation. About 75 million people receive benefit checks from those programs in August, according to the Social Security Administration. But for beneficiaries who rely on those payments to cover essential expenses, the size of the COLA for 2026 might not ease their struggle with higher prices. Yes, now why is that? Well, if inflation is averaging 3% per year and your COLA is only 2.8%, you are actually losing. That's why the old joke, if you will, is always like, when your boss gives you a raise, check out before you get all happy about getting the raise, check out the inflation rate, because if your raise is not keeping up with or a little bit more than inflation, you're actually losing money. You're actually falling behind. So again, always check the inflation rate against whatever increase you're seeing out there. So again, I will say, 2.8%. I don't think that's horrific. Could it have been a little bit more? And here's the thing. I think the bigger impact on Social Security benefits would have been wait for it, stop taxing the Social Security benefits. Why are you taxing the benefits? I think so many people don't understand that when Social Security was originally created, Social Security did not get taxed until 1983. In 1983, they made one of the, I believe it was 7 amendments to the Social Security Act, which began to tax Social Security for the first time. The first, 40 years that Social Security existed, starting from 1934, leading up to 1983, there was no tax. You got your Social Security check, you didn't pay tax on it. And I feel like that's how it should be. I mean, you're paying taxes your whole working life. If you work for 40, 50 years, you're paying taxes all that time. And then to get, to get bludgeoned on your Social Security after, again, it's ridiculous. It's just another example. And, and what's funny about that is that, Donald Trump on the campaign trail did, one of his big things was no tax on Social Security. But yet when we got in there, who killed that? Oh, that's right. The Republicans killed it. It wasn't the Democrats that killed it. It was the Republicans that killed it. And so I think you have to ask yourself, well, why? Why would a bunch of the Republicans have pushed back against stopping taxes on Social Security, and that's where you probably get into one of the uniparty questions. But anyway, I'll leave that for another time. Okay, I'm just pointing out that I think that taxes on Social Security should be stopped. I'm just fervently against certain taxes. I'm fervently against taxing Social Security. I'm fervently against any like estate taxes and all this. I think it's ridiculous, man. I mean, the government just wants to nail you every which way. And while I'm on my soapbox about this for a second, I don't think some people understand this. You work for 7 months out of every year just to pay Uncle Sam. That's right. 7 months out of every year you work just to pay Uncle Sam. 5 months of what you work for actually goes to you. 7 months goes to Uncle Sam. Now, again, you can go look that up. Matter of fact, after you get done this, go jump on Google, go jump on ChatGPT, go look that up. Yes, you work 7 months out of the year to pay Uncle Sam. Okay, taxes. That's it. Okay, so you tell me, if you're taxed too much after reading that. And again, I am not anti-tax. Okay, you need to pay taxes. Okay, do you like? I like having local government. I like having the local township building. I like having a fire department. I like having a police force. I like having ambulance association. I like having these things. I like having a library. I like having a community library. I like having all these different things. I like getting my roads paved. I like, I like public water, public sewer. I like all these things, and you have to pay a certain amount of taxes for this thing. I'm just over, do I think the government should be taking more than, say, 10% of your tax of your whatever you make? I make you make $100,000, right? I think you should, flat tax, 10%. Okay. 10%, you take government, 10% of my money goes to the government to pay for taxes. Okay, that's fine. I can live with that. Okay. When you're making, 100 grand and you're basically paying, $24,000, $26,000 in tax, right to Uncle Sam. And then, you're out there, you're buying gas. You're buying clothes, you're paying sales tax on everything, or, all these, and then property taxes, and you got all these, there's a lot more taxes you're paying than just the taxes you're paying in your tax return. So, all right. I'm going to get off my soapbox on taxes there for a minute, but yeah. So, so I like tax. We do need to pay taxes for certain things, but I also think that we are overtaxed, and I just leave it at that. I think we are absolutely overtaxed. All right, let's move on to the next thing here. Okay, the Fed meeting next week. What's happening with the Fed meeting? So next week, we get our next Fed meeting, and the big question is, will the Fed lower interest rates again? I think it's probably a pretty good shot that they are going to lower the interest rates again. Do I think they should lower the interest rates? Yes, I think they should absolutely lower the interest rates. I think that the interest rates should come down. I think they should be more aggressive. I think they should we should get a 0.5 point rate cut, but they're probably just going to stick with their 25 basis point rate cut. But let's see here. So the next Federal Reserve Policy Committee meeting is scheduled for October 28th and 29th, which is Wednesday and Thursday. I'm sorry. That's actually Tuesday and Wednesday. The Fed is widely expected to cut the Fed funds rate by 0.25 percentage point to a range of 3.75 to 4%. Fed officials are cutting rates because they're concerned about signs of weakness in the labor market and want to lower borrowing costs to encourage hiring. Well, if that's their real concern, they are slow to the party, man. Slow to the party. So again, I think a lot of people expect that there will be another 0.25 point rate cut. The Fed, continues to watch inflation and the unemployment market, yada, yada, yada. But I really think that we have seen this cresting of the inflation. I think at 3%, we've seen the cresting of this inflation. And by the Fed's own projections, they think that the inflation is going to start to come back down next year, 2026 into 27. And I believe that to be the case as well. So we shall see what happens with that and what the Fed does. But the Fed is so reluctant to cut the rates that, again, these 25 basis point rate cuts, over time they will help. Right this second, does that make any big? Like I had people call me up right after the last rate cut and basically were like, oh, hey, they cut the rate, like this is great, whatever this. And I'm like, it's 25 basis points, man. It doesn't mean anything. That doesn't do anything for anybody. We need to see a lot more. That's why Fed Governor Stephen Murin was basically saying, like, no, you guys waited. You've waited 9 months now to cut the rate, and now, so you're way behind the curve, and now you're only giving us a quarter point. Like, come on, man. We need to be a little bit more aggressive with that. But like I said, we'll most likely we're going to get just another quarter point, so that'll take us down 50 basis points here over the last couple of months between September, October, and we'll see where we go from there. Do I expect this rate cut to make some kind of a giant dent in the market or interest rates? No, it's not. It's not going to be. It's not going to. Hopefully they come back and we need to see more rate cuts here. Hopefully December, hopefully January, we get some more additional rate cuts that will help to bring this down to where we need it to be. You start to get 75, 100 basis points down. Now that actually does start to have an effect on things, but again, we need the Fed to move quicker, and they're just, Jeremy Powell's just not doing it, baby. He's just not doing it. All right. Do I want to get to trade stuff? Because I have a few things in the trade to go through, or do I want to go through the articles? Yeah, you know what? Let's switch up gears here for just a second. So what I'm going to do, what I always do in the show at this time of the night, is I'm going to go through very quickly the 5 episodes that I did for this week that just came out. I am also going to give us the economic indicators that would be coming out, and I'm going to also give everybody some banking news for the week, because we had a lot of banking news that came out there. So, all right, we'll do economic indicators first. So Monday on October 27th, we get durable goods orders, Atlanta Fed GDP now for the third quarter. 5-year Treasury note auction on Tuesday, October 28th. We get the CB consumer confidence, the 7-year Treasury note auction, the API weekly crude oil stock. On Wednesday, October 29th, we get the goods trade balance, pending home sales, FOMC statement at 2 p.m., Fed interest rate decision at 2 p.m., and the FOMC press conference at 2:30. On Thursday, October 30th, we get the GDP for the third quarter. And Friday, October 31st, we get core PCE price index, employment cost index, PCE price index, personal spending, Chicago PMI, and U.S. Baker Hughes oil rig count. So that's the economic indicators coming up for this week. Some of them we'll see, some of them we probably won't. We'll go through there with that. All right, let's go. Sorry, guys, I'm kind of losing my tracking here for a second. So we're okay. All right, so episodes from this week. So covered some reports this week, covered some different bank reports that were out. So on Monday, I did a review of the Federal Reserve Bank of New York, their survey of consumer expectations. And so the Federal Reserve Bank of New York Center for Microeconomic Data released their survey of consumer expectations for September of 2025. The report found that household inflation expectations increased at short and long-term horizons, and labor market expectations continue to deteriorate. So in other words, people think that, inflation is going to continue to creep up a little bit, especially inflation on things like food. And it basically, the labor market is going to continue to deteriorate gradually here as we move forward. Then on Tuesday, I did FinCEN offers clarification on bank suspicious activity reporting, or otherwise known as a SAR, the SAR report. So the Financial Crimes Enforcement Network, also known as FinCEN, issued frequently asked questions on issues related to suspicious activity reports. The frequently asked questions clarify regulatory requirements related to structuring, continuing activity reviews, and a bank's decision not to file a SAR. Scott Besson stated, these are common sense yet consequential reforms that will ease regulatory burdens without undermining law enforcement efforts. Yes, I thought this was actually a very interesting episode going through these frequently asked questions. I mean, SAR, for people that don't know, a SAR is a suspicious activity report. And SARs also go along with what's called a CTR, a currency transaction report. So anytime you do transactions over $10,000, basically a CTR report in the bank is filed against you. Now, by law, the bank will never disclose to you when they filed these reports. They absolutely are not allowed to tell you. And bank employees are not allowed to tell you. If a bank employee tells you that this was filed, or when it was filed, or why it was filed, I mean, they can absolutely be not only fired, but they can be fined and they can be prosecuted for that. They can go to jail for that. So it's a big thing. So bank employees are, again, not allowed to tell you about this, not allowed to tell you when they're doing it, but they are doing it. And what has happened here is that a lot of banks have complained because the number of CTRs and SARs, so the suspicious activity report doesn't have a dollar amount on it. That report just gets followed whenever banks think that there's a suspicious activity. If you're doing something out of the ordinary, like in other words, if you never deposit, if you've been a customer of the bank for 10 years and you never deposit a $100,000 check, and all of a sudden you walk in one day and you're like, here's a $100,000 check. And there's really no explanation or rationale for where this check came from, or, there's some company on it or something. And you're like, do you own this company? Like, where's this coming from? And then you're just very vague about it. Like, oh yeah, just making a deposit, that's probably going to get a SAR. That's probably going to get a suspicious activity report on it. So, and then, and again, that gets back to like, what were these frequently asked questions about? Well, that's what they were about. They were about trying to help banks to determine when you need to file a SAR or not file a SAR. Because again, banks can, if you do not file a SAR when you're supposed to, banks can get into a lot of trouble on this. And all this falls under regulation related to BSA, Bank Secrecy Act, and anti-money laundering. Which then leads you back to the Patriot Act from 2001. Banks have struggled with the high number of SARs and CTR reports that they have to file annually. And so a lot of banks have basically said, hey, can we increase the threshold here for and clarify some of the rationale around when we have to file these reports? Because sometimes, again, the default thing is, if it's not clear when you should file the SAR or file a CTR, you just file it. You do it because it's better to have it than not have it, is been the rationale amongst banks because of the way they get beat up by regulators. So again, I thought this was an interesting episode. A lot of people probably, like I said, not probably like the most popular thing in the world as far as like people wanting to see it, but it is a very big topic in the banking business. And and people should be aware of these things. People should understand, as a consumer, you should understand what a SAR report is and what a CTR report is, and why a bank is filing it on you, and why they don't tell you that they're filing it on you, and what does the government want that for. Like, you should be concerned about these things as a consumer, and you should ask some of these questions to try to understand what these things are, and for banks, they should get some kind of reprieve here, because the amount of reports that have to be filed, I think, in a certain respect, have gotten to a ridiculous level. So, but like I said, that's another question for another time. So we'll see that. So, and then on Wednesday, I did review of the CSBS annual survey of community banks for 2025. So this is the Conference of State Bank Supervisors, the CSBS. They've released their annual survey of community banks. Some of the report's key findings include community banker optimism is up. Net interest margins, core deposit growth, cost of technology, and the cost of funds are the main concerns. Regulatory burden fell from number 1 to number 6 in this year's survey. Community banks feel that other regional banks are their primary competitors, but non-bank institutions are gaining. So this is a great, the CSBS does a great job with this report there. I highly encourage anybody who's interested to go look at that report, go find it, go bring it up, because there is a lot of really good information in that report. I think that's one of the best reports that comes out every year. I can't wait to look at it to see kind of what's going on there. They do a great job of really focusing in on community banks, talking with a lot of community bankers around the country and understanding, what's going on, what's affecting them right now, what are their big concerns, how well are they doing financially, how is everything, shaking out. So again, fantastic report from CSBS. Then on Thursday, I did cybersecurity threats are increasing. Does your bank have an incident response plan? So as banks continue to grapple with cybercrime, that includes ransomware, phishing attacks, and business email compromise, also known as BEC, they need to have an incident response plan. However, simply having an incident response plan is not enough. This plan needs to be updated, tested, and practiced annually. So this episode examined an article from the Independent Banker magazine titled Tackling Familiar Cyber Threats with Smarter Tools. So again, definitely want to have an incident response plan if you don't have one. You might want to have a disaster recovery plan and a business continuity plan while you're at it. Okay, then finally on Friday, I did an episode called Win More Commercial Relationships by Mastering the Account Switching Experience. So the account switching experience for commercial banking clients remains one of the most confounding issues. We delve into some of the main bottlenecks, which are redirecting payroll, merchant services, ACHs, customer payments, notifying vendors, and closure of legacy accounts. This is a process that could take 3 to 6 months to complete. The bank that can address this issue will gain a lot of commercial clients. This episode examines an article from Bank Director titled The Hidden Bottleneck in Winning Commercial Relationships. So I wanted to do that episode because that is an issue that is near and dear to my heart, being a banker for the last 25 years. The account switching process is perhaps the most difficult thing that you run into. Getting loans in a certain it's never easy. But getting the loan, doing the loan, underwriting the loan, booking the loan, monitoring the loan, that part of it is not the toughest thing in the world, especially if you're dealing with a borrower who is motivated. If there's a motivation for them, they're buying a property, they need a vehicle, they need equipment, they need a line of credit, they need whatever. So if they're a motivated borrower, it's going to be pretty easy to work with them. They're going to get you all the information. You're going to be able to put it through, get it through underwriting. And as long as they qualify, boom, you're good. You're in business. You go, you get the loan closed, you're good. Moving the deposit relationship over to make it a true relationship. That's the difficult part, because, and again, banks, it's designed this way. Bank accounts are designed to be sticky, right? They're designed to make it difficult for people to switch. Otherwise, if it was easy to move, people would be moving. People would be moving all the time. Banks would see this massive fluctuation in terms of accounts constantly coming and going. So again, when you set up your bank account, you have like an operating account, maybe you have a payroll account, a couple other accounts, and that all begins to that's tied in with the payroll company. You probably have a whole bunch of ACHs out to vendors. You probably have your merchant services, like credit card machine, like everything gets tied in, and it is a massive pain to switch all that over to another bank. That's if you don't have other things going on there. Maybe you use treasury management services, like you use something like Positive Pay to help you combat fraud, or you have remote, maybe you have remote check scanning. Maybe you have a remote scanning machine that maybe you pay $30 or $100 or something a month for that. So again, it's just like there's a lot of things there, and I think that spending time working on that, again, the bank, it doesn't have to be perfect, but if you can somehow make that process better, if you could cut down on that, you're going to win a lot of deposits. You're going to win a lot of commercial relationships, and you're going to win a lot of deposits. That's why I really really liked that episode. I really wanted to do that episode and focus in on that because that is a huge, huge topic. And it has been something that I have spent many a year thinking about how can we work on this? How can we make that better? So, all right, but so those were the 5 episodes that I put out this week. I would absolutely tell everybody out there, if you have not watched, if you've not seen some of the other episodes I've put out in recent weeks, like if you have not seen First Brand Group files for bankruptcy, private credit market in trouble, go watch that episode. Fitch Ratings warns about systemic shock to private credit. Go look at that. I did a 4-part series on AI, basically asking if AI is profitable. That was a very popular series. Some of the other things I looked at were like, was, KPMG, one of the big 4 accounting firms, recently got dinged for the 2023 banking crisis. And I basically asked the question, was KPMG partially responsible for that? Go back, take a look at that episode. I did an episode, what is the myth versus the fact for banks when it comes to stable coins? I did an episode of the failure of the public school system, which I think some people found very interesting. So yeah, I did. Oh, and then I also did SBA launches a new 7A manufacturers access to revolving credit, also known as a MARC loan program. A lot of people love that episode. So again, go back, check out some of these episodes that I think cover really important, very timely topics that a lot of people, again, these have proven to be very popular episodes. People really like these. People are looking at them. So go back and check those out. I think you will find some really good information in those episodes. Okay. Let's get to some banking news, shall we? All right, so agencies release resolution plans for large banks. So the FDIC and the Federal Reserve and the FDIC released the public sections of resolution plans for 15 large banking organizations, including 5 domestic and 10 foreign bank organizations. The banks were required to submit resolution plans by October 1st. The agencies also released a public summary of Capital One's interim update to its resolution plan. Senate panel touts support for bill to raise CTR and SAR thresholds, what I just talked about in that episode just a minute ago. So the Senate Banking Committee published public support from ICBA and other groups for a bill to raise currency transaction reporting and suspicious activity report thresholds. The recently introduced Streamlining Transaction and Ensuring Anti-Money Laundering Improvement for a New Era, also known as the Streamline Act, would raise the CTR and the SAR thresholds from 30,000 or to 30,000 from 10,000 respectively, and index the CTR threshold for inflation every 5 years. So in other words, building an automatic increase in the CTR. So the CTR would go from 10,000 to 30,000, which would be a massive improvement and would dramatically drop the number of CTRs that get filed. So hopefully that act will go through. Okay, ICBA pushes deregulation in the EGRPRA comments. So ICBA called on federal banking regulators in the Trump administration to continue advancing ICBA's deregulatory recommendations via the largest economic growth and regulatory paperwork Reduction Act. Wow, can I say that one? This is the EGRPRA, the Economic Growth and Regulatory Paperwork Reduction Act. That's a mouthful. Holy cow. So yeah, so basically they're working on reducing a lot of these regulatory burdens with banks. So now here's a very interesting one. So ICBA backed a letter to support CDFIs signed by 105 members of Congress. So a group of 105 Republican senators and representatives strongly urged the Trump administration to continue carrying out the statutory obligations of the Community Development Financial Institutions Fund. So they say, CDFIs play an important role in supporting economic development in rural and underserved communities. It is unclear how CDFI fund programs will continue to operate if the fund's obligations cease to function. Eliminating all work done by the CFI fund harm the U.S. economy long term. Well, again, it's very interesting because the CDFI program, I think you could make the case that it has been abused. That program has been severely abused, and there was a lot of what the administration would describe as woke things going on there with the program. And I think the CDFI program, for the most part, is probably a pretty good program. I also acknowledge that, yeah, I think over the last 4 years in the previous administration, it was abused. It was badly abused for things that they were doing with it, and that's a problem. And I'm not sure exactly how you fix that issue. I'm not again there. I wouldn't hold my breath that the administration is going to suddenly turn around because these 105 Republicans came out in support of the CDFI program. Again, what would I hope would happen there? I would hope that something kind of gets turned back on, and that they can figure out some way to maybe put some different guardrails and get that going. But I don't know. We'll see. Okay, what else do we have here from ICBA? So detecting illicit activity involving digital assets requires a bigger effort. So ICBA told the Treasury Department that community banks remain open to exploring the potential capabilities of payment stablecoins, but their promise rests on the government's ability and willingness to deter the skyrocketing growth of illicit finance in the digital economy. So responding to Treasury's request for comment on innovative methods to detect illicit activity involving digital assets, ICBA said while most community banks do not have direct engagement with crypto products and services, the North Korean military is a threat actor. There's skyrocketing crypto scams, and the administration should finalize FinCEN's ICBA-supported proposal to combat crime enabled by cryptocurrency mixers as quickly as possible. So yes. ICBA, CLA encourage agencies to reduce the 1030 spread. So ICBA and the Community Home Lenders of America called on the Treasury Department and the Federal Housing Finance Agency should permit Fannie Mae and Freddie Mac to use their portfolios to help reduce the historically wide spread between 30-year mortgage rates and 10-year treasuries. So that's interesting. So we'll see if anything happens with that. ICBA and other trades urge the administration to halt the CDFI fund cuts. Yeah, we talked about that. ICBA unveils principles for deposit insurance reform. Yes, with lawmakers deliberating deposit insurance reform proposals, ICBA released recommended principles to inform on the debate. So yes, hopefully that will, again, another, I think, really good thing. Hopefully that goes through without problems. ICBA urges the CFPB to expand the 1033 exemption for community banks. That's nice that they're asking to expand the exemption, but I would rather they just kill the 1033 altogether. That's open banking rule for those who don't know. Fed's Waller proposes skinny master account. So Federal Reserve Governor Christopher Waller said the Fed should explore the idea of a skinny master account. So speaking at the Payments Innovation Conference in Washington, D.C., Waller said he has asked Fed staff to explore the idea of payment accounts or a skinny master account, which would provide basic payment services to legally eligible institutions that conduct payment services primarily through a third-party bank that has a full-fledged master account. These payment accounts would have a streamlined timeline for review, would not have daylight overdraft privileges, would not be eligible for discount window borrowings, and would not have access to all Fed payment services. The reserve banks would not pay interest on balances in these skinny accounts, and balance caps may be imposed. So again, that could be interesting. We'll have to see what happens with that. And then finally, senators call for a moratorium on the ILC approvals. 2 Democratic senators called on the FDIC to halt industrial loan company charter approvals until Congress passes a law defining ILCs as banks. Yes, and this is one of the few times where I actually agree with them. Yes, I've done episodes on the whole ILC banking charter, what's known as the ILC loophole in the banking world. I've done episodes on this. I've talked about it, a lot. The ILC is a problem. It's been a problem for a long time, and hopefully something gets done here to address this. So anyway, all right, let's, with that being said, let's get back to some articles here and let's cruise through some stuff here, because I still have a lot to go through with you guys here tonight. All right. All right, let's get into some trade stuff real quick here. So, green shipping plan is delayed after Trump backlash. So, proposal for ship owners to pay a fee for their carbon emissions had been criticized by the U.S. So, this headline is not right. Okay. Basically, what this was the European Union tried to hit us with a carbon tax. Okay. This was an automatic no go. And because, again, this is part of their obsession with the green, BS. I'm just going to put it that way. All the green BS. I mean, Europe has basically, is on this suicidal, zero carbon kick, which unfortunately so are a lot of the people in the Democratic Party here. And this stuff is just, it's ridiculous, this is all, and it's got nothing to do. They always hide this environmental stuff with, it always comes with a tax. Why does it always have to come with a tax? But it always comes with these carbon taxes. And basically, thank goodness for President Trump coming in and saying no. Like, no, absolutely not. Under no circumstances are we going to pay your BS carbon tax. We are not going to pay for your green fantasy. Sorry, not going to do it. So this thing was basically dead on arrival, and I'm happy. But again, don't think for 1 second this is their fever wet dream, is these carbon taxes. They want a carbon tax everybody and everything walking on this earth. So they will, and believe me, they will not. This will not be the last of this. Every time, these guys are like slippery little snakes, man. Every little time that there's an opening, they will come roaring out once again. If it takes 30 years, they don't care. They will, believe me, they will keep bringing this thing back again and again, like The Walking Dead. And again, it's just, and it's unbelievable that they would even try to pass something like this. It's like, again, this wasn't like this something that was just for Europe. This was for the whole world. They were just going to say, okay, sorry, we don't care that you guys don't like it. Everybody's just paying this massive carbon tax. It's like, nope, not paying that. Sorry. So thankfully that got shot down. So now Trump is going to meet with Xi Jinping in 1 week. So the president is meeting with Xi, will be the last event on his schedule before he returns to Washington from his trip to Asia. So White House Press Secretary Carolyn Leavitt said on October 23rd that President Donald Trump will meet with the Chinese Communist Party leader Xi Jinping on October 30th. The meeting will come after Trump has spoken to several heads of state in the region and will cover several hot-button issues, including soybean trade, fentanyl, rare earths, and tariffs. Trump will depart for his Asian tour on October 24th at 11 p.m., which he did, arriving at his first stop in Malaysia on the morning of October 26th, tomorrow. There, he will oversee the signing of a peace deal between Thailand and Cambodia on the first day of the Association of Southeast Asian Nations Summit. Trump will also meet with Malaysian Prime Minister Anwar Ibrahim and join an ASEAN working dinner on October 26th. On October 27th, Trump will travel to Japan, and the next day he will meet with Japan's newly elected Prime Minister Sanae Taikachi. I think I'm saying that right, Taikachi. On October 29th, Trump will fly to Busan, South Korea, and meet with South Korean President Lee Jae-myung. He will also deliver the keynote speech at the Asian Pacific Economic Cooperation APEC CEO gathering and later participate in a U.S. APEC leaders working dinner. Trump's meeting with Xi is scheduled to take place the next day and will be the last event on his schedule before returning to Washington, D.C. Now, Besant, in the meantime, is scheduled to hold bilateral talks with Chinese delegation in Malaysia. So Trump says the United States is in a strong position in trade negotiations with China. Treasury Secretary Scott Bessent said he will meet with a Chinese delegation in Malaysia next week. So Bessent accused the Chinese regime of initiating a substantial unprovoked escalation last week by imposing sweeping export controls on rare earth minerals. The Trump administration has since rebuked Beijing for these actions, threatening a 100% tariff on Chinese goods entering the United States. So Scott Bessent is going to go talk to them this week and see if he can perhaps iron out a few of these points before President Trump meets with Xi Jinping on October 30th. But we'll see what happens with that. In the meantime, the U.S. is investigating China over compliance in the trade deal from Trump's first administration. Finding that China failed to uphold its commitments may result in tariffs or other penalties. Yeah, it is a foregone conclusion they did not They did not abide by this trade agreement. That is 100% certain. China doesn't abide by anything. That's what makes this trade negotiation so difficult. China is like a giant bully, right? There are, and just so people understand, China is already at war with us. China is at war with us in very aspects, trade war, economic war. China is already at war with the United States. People need to understand that. Um, I'm going to be doing an episode on China here that's going to come out in the next 2 weeks, where I'm going to cover a broad range of China related to topics. And one of them is going to be an article from somebody I thought a great opinion piece, basically saying that like how corporate America needs to wake up to the Chinese threat. They need to wake up to the fact that like China is not your friend. Okay. I know, people like Nike like to, get all their stuff made over there, but that the days are changing. The day is a changing, and the winds are blowing in a different direction. And it's time for a lot of corporate America to wake up to this reality that China is not your friend. China is not going to help you make money much longer. And thus the only way for us to deal with them, and again, I've talked about this ad nauseum. The how we have allowed ourselves to get so intertwined with China economically is just it's insane. How we have put ourselves in this position where they are basically able to cut off the rare earth minerals and the magnets and everything that we need for so many things. We need that for pharmaceuticals. We need that for defense weaponry, for building computers, microchips, satellites, the whole 9 yards. They really have us over a barrel. Does that mean, to Scott Besson's point here, does that mean that we have no, do we have no ramification, or do we have no way of basically fighting back or basically digging back at that? Of course we do. We absolutely do. We have a number of tools in our toolbox. The problem here is economic. Like, in other words, how much of an economic impact are you willing to take? How much of an economic hit are you willing to put on the economy in order to win these concessions out of China? That's the big question. And I want people to think about this. I believe, we're already in a trade war with China. I think I don't think that these negotiations are going to amount to a hill of beans. And even if China agrees to anything, they're not going to honor it. They are not going to honor it. I will save everybody the time and effort. They're not going to honor it. And I think Trump knows this. I think Trump already knows this. I think he already realizes it. I think that again, this is just a game, and you've got to play the game out. And I think that's what he's doing here. I think they already know that this trade war with China is going to get a lot worse before it gets better. And and both sides, think of it like a heavyweight fight. This is like a heavyweight prize fight. Okay, the two biggest heavyweights are about to come at each other, and they're going to have some blows. And it's one of those things where it's like, yeah, we might win the fight at the end of the day, but you're going to get bloody. You're going to get bloody. You're going to give some hits, and you're going to take some hits. And that's where it gets back to, corporate America. People here in America, I think a lot of these corporate executives need to wake up to this reality of what is coming potentially down the pike here. So anyway, okay, all right, I'll get all off that for the moment. All right, let's go on now. This was great news. So the U.S. and Australia signed critical minerals agreement with $8.5 billion projected pipeline. So President Donald Trump and Australian Premier Minister Anthony Albanese signed an agreement on critical minerals that Albanese said includes plans for projects worth a total of up to $8.5 billion. Albanese said there will be 3 groups of joint projects between the two countries, which will include companies such as Alco. The U.S. will invest in rare earths processed in Australia, the Prime Minister said. The White House described the agreement as a framework. So this helps, right? This helps us get some of those rare earth minerals and some of those things that we needed very desperately. The question is, how quickly can we get this stuff? How quickly can we get this stuff from Australia? Well, we'll have to see. Hopefully we can get it sooner rather than later, but this is absolutely a step in the right direction. Now, I've said this to a lot of people. I'm saying this on the live stream for the first time. And I think a lot of people would probably lose their mind with this. But Russia, I'm just going to say this, Russia's got a lot of those rare earth minerals that they need. And Vladimir Putin did offer a few months ago, he basically said, yeah, I would be fine with cutting a deal with the U.S. to sell you guys a whole bunch of this stuff, whatever you need, because I got tons of it. Now, I know that, again, I know that would freak a lot of people out, but I will tell you this. If we can end this war in Ukraine and the U.S. could start doing business like that with Russia, that pulls Russia away from China. That is a deterrent to World War III. I know a lot of people are not going to want to hear that, but it would be a deterrent to World War III. Okay, that we start working some deals like that with Russia and start working some things out. That would be a massive deterrent to World War III. And again, I know some people are not going to like that. They're not going to be like that. That's a hard no. It can't go there. I'm just saying. I would not close the door on that. That's all I'm saying there with that. Okay. Now, here was perhaps the biggest tariff news of the week, and that was with Canada. So basically, the U.S. terminated all trade talks with Canada over this Reagan TV ad. And I don't know if you guys saw the Reagan TV ad, but basically what happened was this one Canadian premier, this guy Ford up there in Canada, he took an old Ronald Reagan speech on tariffs. And what he did was he of course, he took out the soundbite that he liked, that he wanted, that basically where Reagan was saying, oh, tariffs are terrible and they don't help and this, that, and the other thing. But you have to, it was taken completely out of context because you have to go back and look at the whole speech. Reagan talks about how free trade is what you want and how, yes, if you use tariffs to kind of bludgeon your trading partners or get one over on your trading partners, they blow up in your face. But if your trading partner is taking advantage of you, okay, as Canada has been, okay, then using tariffs to even the playing field is absolutely reasonable. Okay, so he cut what he didn't want and he stuck it in this ad. And again, it was ridiculous. The whole thing was ridiculous. And so, Trump freaked out, obviously, and basically said, all right, that's it. We're done. We're done. So now Canada's freaking out. And this was breaking news. I saw this came out just a couple hours before I came on tonight. So Trump hikes tariffs on Canada by 10% over Ontario ad. The measure was in response to what the U.S. president called misrepresentation of Ronald Reagan's comments. So the U.S. will impose an additional 10% tariff on Canada, President Trump said on Saturday, a punitive measure in response to an ad campaign that he said misrepresented comments by former President Ronald Reagan. Because of their serious misrepresentation of the facts, a hostile act, I am increasing the tariff on Canada by 10% over and above what they are paying now. Trump posted this on his Truth Social platform on Saturday. So again, Canada just continues to shoot themselves in the foot. Yeah, just absolutely ridiculous. It's like how stupid can you possibly be? That is, Canada, Canada, please just stop. Like you guys could work out a fair agreement with us, like real quick. Okay, just stop being stupid. It's just unbelievable. It's unbelievable. They'll learn. They'll learn. Their economy is going completely into the tank. Okay, they'll learn. They'll figure it out. They'll figure it out soon enough. Okay, now here's some interesting. A little bit more. I talked about Charlie Javis in the Strategy Room live stream here a couple weeks ago. And I kind of cut that out and put it out there as a little bit of a shorter bonus episode. It's only like 10 minutes if you guys want to go watch that to give you a little bit more background on good old Charlie. But now JP Morgan is crying foul yet again because apparently part of their deal basically said that if there was a dispute that arose, that JP Morgan agreed to pay the legal bills. So JP Morgan has now forked out about $110 million for the legal bills of Charlie here and her other accomplice, the other executive in this matter. So now basically JP Morgan is coming back saying, no. she committed fraud. She was convicted of committing fraud, and now we would like to get our legal fees back, and we want to stop paying the legal fees going forward. So this is what this next level of the dispute is about. So we'll see what happens there. My guess is that JP Morgan probably easily wins this because of her fraud conviction. Now, apparently she is appealing this fraud conviction. I don't think that's going to go anywhere at all. But we'll see what happens there. So, okay. Some other banking news here for you guys real quick. So the OCC just started with community bank deregulation. So the OCC is hoping a reduction in regulations will allow community banks to better compete with credit unions and large banks, according to Comptroller Jonathan Gould. So raising the OCC's threshold for community banks to $30 billion and announcing sweeping deregulatory changes for those institutions is just the start of the agency's effort to reduce regulatory strain for community banks, Gould said at an industry conference on October 20th. The agency is now looking at its Community Reinvestment Act, CRA oversight, and implementing the stablecoin-focused Genius Act with community banks in mind, the regulator said. Recently, a community banker quite pointedly told me that if things don't change, essentially credit unions are going to replace community banks, Gould said. So providing regulatory and supervisory relief to community banks has been one of the things that I have tried to place an immediate down payment on. So, okay, so we'll see. I mean, obviously, the threshold for community banks to increasing that to $30 billion and announcing other changes, hopefully working on CRA adjustments and the Genius Act implementation. That would be good. That would be good. So 2 weeks ago, it introduced guidance and proposed rules that will lead to less strenuous exams and faster approvals for growth initiatives like M&A and branching, among other things. So, for banks with below $30 billion in assets. So, which is a lot of banks. There's a lot of banks out there that have less than $30 billion in assets. So, okay, so that's good. Hopefully we'll keep going with that. Fed advances major changes to stress test. So the Board of Governors of the Federal Reserve voted on October 24th to advance a series of proposals to change its stress test, including by disclosing and seeking public comment on the models it uses. The Fed had said in December 2024 that it would consider a range of changes to improve the transparency of the stress test and reduce the volatility of the capital requirements that result from it. The stress test assesses large banks' ability to withstand a hypothetical severe global economic crisis, and an element of their required capital is largely determined by projected losses. Banks groups had simultaneously sued, seeking changes to the stress test, and later agreed to pause the litigation as the Fed proceeded with its work. They welcomed the proposed changes, saying they would improve the accuracy and transparency of its stress testing models and the stress testing framework more generally. So, so we'll see what happens there. Fed Governor Michael Barr, he basically said they will lead to overly optimistic projections in the stress test, both because of its less conservative modeling choices and because of the potential for gaming by banks. He said this will lead to weaker bank capital requirements. So basically he was not, Michael Barr was not in favor of this. So we'll see, but obviously, these are still discussions. So these are just a series of proposals, but we will see. We'll, continue to keep an eye on that, and we'll see what happens. U.S. depositories return to buying more insurance units than selling. So U.S. depositories are buying more insurance units and selling, marking a return to form after 2 years of sales that either kept pace or outpaced acquisitions of the businesses. So again, this is just kind of an interesting thing that I like to point out because banks had this issue on their balance sheet called unrealized losses in their bank bond portfolios. And for the banks that decided to sell to try to correct that issue, a lot of times they were taking a loss in that sale. So one of the strategies for recouping the money to cover that loss was to sell. If they had an insurance division, because they were getting massive premiums for their insurance divisions, it was basically to sell the insurance division and then take that money to cover the loss from the restructuring. Another strategy they were using were called sale leasebacks of their bank branches. But it looks like the tide is kind of turned on that, at least for the moment, and that banks are back to buying insurance businesses or adding insurance businesses again. So again, just something interesting I wanted to point out there with that. Credit unions, commercial lending foray riddled with risks and rewards. So credit unions are moving away from their consumer focus, encroaching on banks' commercial lending territory. And this gets back to the comment made by the community banker in one of the last couple articles about if community banks are or if credit unions are continue doing what they're doing, they're really going to have an impact on community banks. So the credit union industry's commercial loan exposure has climbed over the last few years, reaching 11% of their total loans as of June 30th, up from 7.7% at the start of 2020. Meanwhile, community banks' commercial loan exposure has remained largely stagnant at about 67% of total loans since the Paycheck Protection Program inflated totals in 2020. While moving into new lending areas comes with additional risk, credit unions have been willing to take on that risk for the sake of diversification. Many are taking precautionary steps, such as working with a coalition of other credit unions. There is a massive amount of sophistication that's happening in the credit union industry. Charles McQueen, president and CEO of McQueen Financial Advisors, said in an interview, "Commercial lending is core to the success of any credit union over $1 billion in assets. Credit unions' commercial lending market share could reach 30% in the next 5 to 10 years. Commercial real estate lending segments have grown the most at credit unions over the past 5 years. Multifamily loans posted the highest loan growth, rising by 179.5% to $43.8 billion in the second quarter from $15.67 billion in the first quarter of 2020. For credit unions, multifamily feels familiar, making the category a natural extension for those moving into commercial lending. Now, I would remind people of something here with the credit unions, and that is this. We had this little thing about 30 years ago called the savings and loan crisis. Now, what happened? Well, savings and loans, we had some deregulation, and they allowed savings and loans to go from basically making residential mortgages, which was kind of a safe and sound practice for many years, to get into commercial lending. And the savings and loans went nuts making commercial loans. This whole thing blew up spectacularly, and it sunk hundreds of savings and loans. Why did that happen? Well, because they didn't really have the expertise to do commercial lending. They didn't really know what they were doing, and it all blew up in their face. I see a lot of parallels to that here with what's happening with the credit unions. Credit unions have always been told that, hey, you got to keep your commercial lending to a very small percentage of your loan portfolio. And a lot of credit unions didn't venture down that road because they did not have the expertise to do that kind of lending. Now, with the growth of a lot of these credit unions, you're seeing credit unions grow to be $4, $5, $6, $7, $10 billion in asset size, basically rivaling many community banks out there. And so they are now expanding their commercial lending. And so very interesting. I think we need to keep a very close eye on this, but it is becoming a big issue. And this is why I also think that credit unions need to lose their tax exempt status. They need that tax exempt status needs to come away from the credit unions, especially once the credit union gets to be $1 billion or larger, because at that point, they basically are a bank. If a credit union is $3-4 billion in asset size and they're making all these commercial loans, I hate to say it, they're a bank. They are a bank at that point. Like, they're not a credit union anymore. They're a bank, and they should be paying taxes just like every other bank out there. But we'll keep an eye on that. U.S. dollars historic slide on pause due to lack of government data. So one of the worst U.S. dollar performances in decades has been at least temporarily halted by the federal government shutdown, which has given the greenback a surprising boost. The U.S. dollar index, which tracks the dollar against some of its currency peers, fell nearly 12% from its most recent high in January to about mid-September. But since the federal government formally shut down on October 1st, the dollar has seen a modest rally, rising as much as 1.7%, while little to no sign that a resolution could be near. So again, the value of the dollar has dropped down here, but is staying a little steady for the moment during this government shutdown. So we'll keep an eye on that and see what happens. So this is interesting. So, and I wanted to point this out. So, investor calls for Eastern Bank shares to consider a sale. So, an activist investor that previously pushed Comerica Inc. to sell is now calling for Eastern Bank shares to consider a sale to M&T Bank or another larger bank. Holdco Asset Management, which said it owns about 3.1% of Eastern's outstanding voting shares, released a presentation criticizing the bank holding company's management team for its capital management decisions, including a series of acquisitions and multiple securities repositionings. Yes. Yeah, Eastern Bank shares is up there in Boston, and they have gotten pretty beat up in recent years. They had some tough things going on in there. Now, why did I want to point out this article in particular? Well, it just so happens that a week ago, I did an episode called How Can Bank Boards Deal with Shareholder Activism? And in that thing, I said, with the bank M&A market heating up, shareholder activism could be on the rise. And here it is. This episode examined a recent article from Bank Director titled Shareholder Activism Could Heat Up. Should Boards Fight Back? With the recent announced acquisition of Comerica by Fifth Third Bank, what we just talked about here in this article, it was revealed that an activist investor, Holdco Asset Management, was seek to push the share of the bank. So what can banks do if faced with an activist shareholder? And this article offers several strategies that a bank board can implement, along with considering whether or not they should be combative. So again, I wanted to point that out because that episode, while again, not being the most sexy thing in the world, actually it was pretty important because I saw that we were going to start seeing some more activism by shareholders out there. And it raises a big question of what can bank boards do to try to combat that. So there you have it. Okay, now I'm gonna show you guys. We're gonna go rapid fire here. If you guys could just give me another 10 minutes to wrap up here for tonight. I'm going to go rapid fire through a bunch of articles here. We're going to get back to what we started with at the beginning of the night. I want to show you guys now some things that came up with a lot of these other banks as it related to this whole kind of credit quality issue, as it relates then ties back to, again, the private credit market, the subprime auto lending issues. So Fifth Third, Truist flag non-bank lending. In other words, the lending they did in the private credit market. So as Zion's, Western Alliance, and other banks revealed exposures to non-bank lenders, one analyst noted that concern around the sector is the topic du jour. Oh, you bet it. Better believe it. So Fifth Third logged 778 million net charge-off in the third quarter, tied to a bankrupt subprime auto lender Tricolor, as concerns around banks lending to non-depository financial institutions, NDFIs, I talked about that last week, proliferated during this week's earnings calls. So additionally, and then let's see here. Additionally, Regions lenders Zion's and Western Alliance this week disclosed bad loans linked to allegations of fraud. JP Morgan said they were writing off 170 million. So again, there's some growing fears of more cockroaches, has heightened concerns related to regional banks in particular, where losses may be more consequential than for mega banks. Investors are now squarely focused on NDFI risks, and little else even matters for banks when credit questions emerge. Yes, I would agree. And then we're going to go in here. So credit quality shadow hangs over U.S. banking industry third quarter earnings calls. So credit quality was top of mind during U.S. bank earnings calls as the industry reeled from a spike in one-off credit events. Remember what I said earlier? Everyone's going to describe these as one-off credit events. You know, oh, this can't happen. Oh, don't worry about it. No big deal. You know, and again, you know, we talked about this, but you know, Zion's related credit issues during the quarter, 50 million in charge-offs. You know, Huntington Bank shares. You know, there's a number of banks here have said basically, hey, they got some stuff. You know, similarly, United Bank executive said his credit metrics were roughly flat even after the company disclosed a 26 million non-accruing NDFI loan and reserved 19 million for two other loans that generated 14.7 million in charge-offs. And despite reporting a 30% sequential increase in non-performing commercial and industrial loans, resulting in part from exposure to the First Brand's bankruptcy. So, so U.S. Bancorp President and CEO Gunjan Keita said the company remains confident in its underwriting. So, and then you had other credit events, other credit events during the third quarter, not limited to NDFI lending. So Washington Trust Bancorp faced tough questions around its credit quality during an October 21st earnings call. And two other examples, Bank of the OZK had 3 negative credit migrations. Service First Bank shares reported an increase in non-performing assets. M&T Bank's net charge-off rate increased 10 basis points during the quarter. So again, this is not a one-off. You are seeing this now a bunch of regional banks. What B of A CEO calls for more regulatory oversight of non-banks. Bank of America Chair and CEO Brian Moynihan called for more oversight of the stablecoin and private credit industries as they encroach on banks' territory. As stablecoin gains traction as a payment option, banks need to innovate in order to not lose deposits, Moynihan said. And let's see here, recur companies. Moynihan also touched on the rise of private credit, calling the playing field unlevel, since those companies make loans like banks do without the oversight banks receive. Oversight cannot be compromised without returning to a system in which all parties are free to do what they want, he said. Moynihan cited the creation of the Consumer Financial Protection Bureau, which was partly intended to bring financial companies outside the existing regulatory regime under more oversight as an example. They were not in the same regime, and so the idea was to close it down and say, if you make a mortgage, you're going to have the same regulation of activity. So again, but he's calling, the CEO of Bank of America, he's calling for this now. Western Alliance CEO says alleged loan fraud is incredibly frustrating, but an isolated issue, the one-off. It's an isolated issue. Western Alliance is one of the regional banks facing concerns over loans made to non-bank financial players. The bank CEO said he believes the alleged loan fraud that sparked a sell-off last week is an isolated case. The Cantor Group episode forced Western Alliance to review other loans in its note finance portfolio. So, yes, and then we continue on here. Service First, underperforming assets jump, share price faces pressure. So an increase in Service First Bank shares non-performing assets was driven by the company's relationship with a borrower that rehabilitates multifamily properties. So again, issues there. Zions elaborates on NDFI risks after large charge-offs. So Zions Bank provided some additional color after its lending to non-depository financial institutions and the general risk posed by private credit, while otherwise declining to disclose further details on credit losses related to 2 loans. So so you can be sure that Zions is going to have some other bad loans cropping up here. Ally shrugs off consumer credit worries as auto loan losses improve. So Ally Financial pushed back against fears of consumer weakening, reporting stronger auto loan quality for the third straight quarter. Okay, maybe. I would go back to this. 6.43% subprime. Yeah, I'd go back to that. Okay, Barclays is satisfied with their private credit exposure after the tricolor hit. So Barclays announced that they were taking $60 million hit here for Barclays, something in that range from First Brands. They announced $110 million impairment charge related to exposure to tricolor in the third quarter. Barclays taking a big hit here on this. Bank United calls problem credits an exception. So Bank United has set aside $19.1 million primarily for a commercial industrial loan and a commercial real estate office loan that generated $14.7 million in net charge-offs, and reported that a $26 million loan to a real estate investment fund is non-accruing. The company has $1.3 billion in exposure to non-depository financial institutions. So you can bet that more will be cropping up with that. First Citizens quantifies First Brands exposure, expresses confidence in credit. So First Citizens Bank share posted a jump in third quarter charge-offs driven by exposure to First Brands Group, while broadly expressing confidence in its credit book. So again, I'm just showing you guys the pattern here. I'm showing you the pattern of all these banks. Eagle Bank Corp shares dropped by in the third quarter. Loss surpasses estimates amid credit noise. Eagle Bank Corp is facing stock price pressure and reporting a third quarter net loss that was worse than analysts expected. And then amalgamated. I always have a tough time. Amalgamated, unfazed by political headwinds. Now, now Amalgamated is kind of a different story. Amalgamated Bank is really tied in with the Democratic Party. They basically bank the Democratic Party. So they've got different issues going on there as far as like they could face some pushback. But they also have some credit concerns too. I mean, Amalgamated, when New York Community Bank Corp almost went under last year, that is basically that was the parent company of Flagstar Bank. Amalgamated was right behind them, and they've managed to kind of hang in there and straighten some things out. But I was looking hard at Amalgamated Bank last year, going, yeah, they could be on the next, they could be on the list right next. But they, like I said, they were able to hang in there. But they could have some other issues going on there right quick. So, but again, just to recap, again, credit quality hanging over the industry. Fifth Third, Truist Bank, Zions, Western Alliance, all having issues here. What did I want to say here? What did I miss here? So, where was the other article I was looking for here? Where's it? B of A CEO, he wants more oversight on private credit. Western Alliance's issue. Service First issue, Zions. Just Ally Financial, Barclays, Bank United, First Citizens Bank Corp, Eagle Bank Corp. There's a lot of banks going down this list. And then let's see here. And then a couple of interesting things here. Last couple of things I got here for you guys. So auto stocks surge as car makers navigate policy shifts with robust sales. So General Motors and Ford shares have taken off after the car companies reported strong sales and said they'll have an easier time adjusting to federal policy changes. Domestic car companies may benefit from less strict emission rules and a more lax approach to tariffs on certain auto parts. So we'll see what happens there. But so far, Ford and General Motors apparently putting forth good sales. So the rest of the world is following America's retreat from electric vehicles. So Canada, UK, and the European Union back off electric vehicle targets as economic reality sets in, and even China shows cracks. So this is kind of interesting. So General Motors announced a $1.6 billion charge because of sinking electric vehicle sales, attributing the shift to reduced government subsidies. The U.S. retreat from the electric vehicle ambitions is spreading around the globe. So again, I just wanted to point out that this trend, you're now seeing this kind of falling through. And it was kind of interesting to point out this week that Tesla, had their earnings revenues that were not too bad, but Elon wouldn't really comment on kind of the future of EV sales. So that was so again kind of an interesting thing to note there. So that trend. So okay. All right, guys. Well, that's what I got for tonight. So we'll go through. Let me run through before I do our story of the week and our quote of the week. I just want to go through here. I just want to go through here. I didn't have my items for. Okay. All right, here. Let's go in here. Okay, so yes. So basically, I keep forgetting the banner thing here. So let's get some of these banners up here. Okay, so if you are on Apple Podcast or Spotify, do me a big favor. Please leave some reviews for me on Apple Podcasts and Spotify. Make sure to visit the bankernextdoor.com, as that always helps us out. There's a lot of great things on the website there. Make sure to subscribe on YouTube to get the latest updates via posts. I always post out like what's going on or what's happening. And then make sure to send any comments that you might have to send comments, questions, or topic recommendations to info@thebankernextdoor.com. That's how you can send me an email. You can get a hold of me. Make sure to follow me. You follow me on Getter X and Truth Social. BND is on YouTube, Rumble, and all major podcast platforms. We put out new episodes every week, Monday through Friday, premiering at noon. And don't forget, we have BND Strategy Room every Saturday night at 8 p.m. So that's our stuff there. And I'm going to tee up here. So let's turn that off. And then let's go to our story of the week, shall we? So, okay, so we are going to do the dot plot. That is going to be our story of the week. So the dot plot, also known as a strip plot or dot chart, is a simple form of data visualization that consists of data points plotted as dots on a graph with an X and Y axis. These types of charts are used to graphically depict certain data trends or groupings. The most famous dot plot is perhaps the Fed's projections for interest rates that are published each quarter. A dot plot is similar to a histogram in that it displays the number of data points that fall into each category on value on the axis, thus showing the distribution of a set of data. So that is the dot plot, which is used by the Federal Reserve to basically show us what they think the future of interest rates will hold for us, like whether they think interest rates are going to go up or down over the next year or two. So I have shown people examples of the dot plot in the past, but again, always good to touch on these things. And then finally, our quote of the week. So, and I thought this was very apropos just because of what happened with Canada, with them trying to, cut a piece out from a famous speech from Ronald Reagan. So I figured I would give a quote from Ronald Reagan. So our quote of the week here is, "Freedom is a fragile thing and is never more than one generation from extinction. It is not ours by inheritance. It must be fought for and defended constantly by each generation, for it comes only once to a people. Those who have known freedom and then lost it have never known it again." And that was from Ronald Reagan. And that was an exact quote from an exact speech, not cut or taken out of context. So, with that being said, I thank you. I thank you guys all so much for listening. I hope everyone has a great weekend out there. I will see everyone again next week, Saturday night at 8:00. Please come check me out. Hopefully with a new camera next week, so we get a better, just everything is better. Hopefully, back to normal, as it were. So, but have a great weekend out there, everybody, and I will see you again real soon. Thanks for listening. See you guys later.